broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Prashant, with me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Hi, good morning, Prashant. Good morning, Nigel. Start of another day, and doesn't look like it's going to be a good start given what the SGX Nifty is suggesting.
Yeah, but you know, and the inflation numbers last night did not cause an earthquake, right?
Yeah.
I mean, barely a flutter, actually. And it's at least looking at the way US markets closed, not very much.
Yeah. I think there were two numbers. One was the expected number, and one was the buzz that was there in the lead up to the announcement. You know,
thankfully, the buzz was that it'll be hot.
It'll be very, very hot. So it was hot, but it wasn't ekdam garam.
Absolutely.
Wasn't burning hot.
Burning.
You know, so let's just start with that, really, in terms of, you know, the setup this morning, in terms of what you should pay attention to. So inflation is coming off. I think, you know, let's just, before we get into the, you know, 0.4, 0.5 month on month, 6.5, 6.4 year on year, the message is that inflation data threw up hopeful signs. That inflation in the US is moderating. There is absolutely no two ways about it. So we are no longer at, you know, between 6 and 8% inflation, which was the norm in 2022. Looks like 2023 is more like between 4 and 6%. Will be between 4 and 6%, the way things are going. But the overall numbers, right? I mean, if you remove the cover, under the hood, there are still signs that, you know, some components of inflation which are important in the US are still being very sticky. You look at owner's equivalent rent, which is a large weighted sort of component within the CPI number. You look at services inflation. Goods inflation, of course, has come off quite a bit, but services is more sticky always. That is still kind of looking, you know, sticky and high and strong. So many are kind of looking at this number and saying, well, okay, it's coming off, but the fact is that, you know, it's slow. The process itself is slow. The disinflation process is slow. And it's challenged by very sticky prices here and there. So it's not a one-way clean slide, as some would have hoped for, as most would have hoped for, that this problem is behind us. It perhaps will be with us, but it's going in the right direction. The disinflation process is on, although it's a bit slow. You had Fed officials coming through, right? I mean, at least 4 of them who came and spoke after the CPI number. So we have a real-time sense of what the Fed sort of makes of this number. All of them kind of made the simple point that more rate hikes are necessary and interest rates need to be held higher for longer in the US to bring this under control for once and for all and not leave the job half done. So that's point number 2. What was the market reaction? US yields were higher. You had, I mean, the 10-year, for example, went up, the 5-year was up, 2-year was up. But equities and the dollar both were absolutely flat, notwithstanding NASDAQ's move up of about 0.6 odd percent. So it's a bit of a confusing kind of picture, not very clear. Later in the US, we get the the retail sales, monthly retail sales number, and that should tell us a little bit about the health of the US consumer. This is also going to be important, but the CPI was the big one, which has kind of left us, I would say, in a bit of a inconclusive kind of a zone. All right. The Nifty, just to come to markets and levels here, Nifty seems poised finally to break out of the range. We've kind of treaded water within the budget day high and low range for some time now, and it looks like we perhaps could break out. So a close above, we got very close to this level, 17,960. It's nothing but, you know, there's a rising channel starting from the 3rd of February, right after the budget. It's got a couple of touch points since then. And the upper end of the rising small channel is 17,960. A solid close above it, I think, opens up bullish hopes from here on. And day before yesterday's low on the Nifty was 17,720. I mean, if you want this up move to sustain, that level should not be broken on the downside. Bank Nifty took out the 20-day moving average finally yesterday. And now I think the 40-day exponential comes into focus. That stands at 41,864, which is the important number. And again, for the Bank Nifty, one hopes that Monday's low of 41,158 should hold on the downside. Those are you know, some resistance and support levels to watch out for. But broadly for the index, you know, a solid close above. The Nifty, that is, a solid close above 17,960 perhaps will make it more plausible that the market is breaking out of this range and perhaps heading 18,000 plus kind of levels. Sorry.
Absolutely. And, there is a case being made that this perhaps could be the final leg of the inflation battle in the US, right? I mean, it's eased for 7 straight months now in the US, the inflation number, although it is still, not as per the RBI, the Fed's comfort zone. The Fed's target rate of 2%, US inflation continues to be above that. But there is a case being made perhaps for A, the Nifty to break out above the range, and B, for this being the final leg of the battle against inflation. So in that context, it's positive for the bulls. The other positive thing is that it's the 3rd consecutive day of buying from foreign investors. So both FIs and DIs bought in the cash markets yesterday. FIs bought about 1,300 crores, DIs bought about 204 crores. So these are 2 reasons why perhaps you could, see the market buy the dips. Of course, this morning, the SGX Nifty is indicating that the start will be in the red, but I won't be surprised to see the market gravitate towards the upper end of that range. The levels, the 100 DMA, 17,950 thereabouts is something that the Nifty is approaching. Let's see if we can break out above that. For now, the odds are stacked in favor of the bulls, but let's see which way it goes. A lot of the numbers that came in, of course, we are at the faggest end of the earnings season, just, last 1 or 2 days. It was a weak quarter from a lot of the names that reported yesterday. Bata, Apollo Hospitals, ONGC. Some strong numbers came through as well. We talk about that as well. But some more numbers left, the likes of Nestle. So from the consumption basket, we'll watch out for that. But all in all, you'd have to say, although the handover from the global markets was a bit weak, the Dow was under pressure, SGX Nifty is down. But the internals suggest that perhaps we could break out above that range. Yesterday was a good day as well for the Nifty. So let's see if today the dips get bought.
Well, that's right. And I've been making this point that the FIs being net short in the index is not such a bad thing. And it appears the FIs have turned the corner, at least in the near term. As Sonia mentioned, they have been buying for the last 3 sessions, which is wonderful. Also, the F&O market, the cues are quite encouraging, which we'll get to just a bit. So have the FIs turned the corner? The Nifty IT index could outperform yesterday. We pointed that out yesterday. The Nasdaq again had recovered big time from the low point of the day. So could it move in sync yet again? I think that is a possibility. And also, if the Nifty holds its ground, then maybe the broader markets can fire as well. Yes, it was a little bit disappointing that the broader markets that were still under pressure, the mid-cap index as well was a relative underperformer. Moving to the cues coming from the F&O market, well, there was good amount of institutional buying number that we saw yesterday. But in the F&O market, there was clearly a short covering bounce that played out, both on the Nifty Bank as well as on the Nifty. What did the FIs do in the F&O market? Well, they got stumped on the wrong side. They covered close to 34,000 short contracts and they added close to 7,000 longs. That's a swing factor of around 41,000 contracts. So from having close to 80 to 83% of their positioning on the short side, that's come down to around 73%. They continue to remain net short on the markets, and that could provide us that much needed boost or that much needed tailwind as well. For me, the most encouraging aspect was they covered shorts and also they wrote puts yesterday. And earlier they were writing calls ad nauseum. Yesterday, in fact, some of those calls, well, they were unwound. So let's pull up a couple of active strikes yesterday. The PCR has moved up to around 1.1 odd, and the calls that were written earlier, they got unwound. And there was put writing, 17,700, 17,800, 17,900 put. They saw a fair bit of writing out there, which brings us to the level. Since the 17,900 put was getting written, well, the 17,830, that becomes a crucial support zone. So that's 100 points lower from yesterday's close. While we expect to see some bit of resistance at around that 18,000 odd mark, the Nifty Bank essay closed beautifully. 20 DMA and 100 DMA, both of them, very close to those levels. So can it move towards the 50 DMA? That's going to be very, very important for the Nifty's up move. And the near term, I'm looking at support at around 41,200 odd because we did see a bit of a bounce from there. SGX Nifty suggesting a downtick. That's not a bad thing. It gives the bulls an entry opportunity. 17,830, the crucial mark on the downside for me.
All right, Nigel, so that's interesting levels and cues to watch out for. Thanks for that. Before we start, let me quickly run you through what's lined up in the first half hour of the show today. We will get you updates from markets across the globe. Matt Orton of Raymond James Investment Management will join us to discuss the global trade setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks to watch for the day. And at 8:30 this morning, Nischal Maheshwari of Centrum Broking will make an appearance and we'll talk markets, levels, stocks with him in a bit.
All right, so we have lots coming up on the show in the next 2.5 hours, but without wasting any time, let's kickstart and tell you about our first view of the day coming in from Gautam Dugar of Motilal Oswal Financial Services. He expects the markets to remain in a range and react to earnings, inflation and global cues. Among sectors, he likes autos, BFSI, IT and select consumption stocks, while banks are looking quite attractive now. His stock-specific preferred ideas include ICICI Bank Axis Bank, SBI, ITC, Infosys, Titan, M&M and Maruti. So that's the list he likes, while he is avoiding new age tech companies and Adani Group stocks at the moment.
Well, let's get you some money market views as well. Kunal Sudani of Shinhan Bank says the US dollar traces yields to rebound despite softer US inflation data. He says hawkish Fed talks are the key, and Fed funds futures are pricing in rate rises in March and May. According to him, the dollar index finds resistance at 104.1 levels, and all eyes now remain on US retail sales data due today. For the dollar INR pair, Kunal says 82.6 to a dollar acts as a support, while 83 to 83.1 to a dollar is a resistance.
Okay, and on the bonds, Ajay Magnolia of JM Financial says disappointed with US inflation print at 6.4%. US yields have hardened by 8 to 10 basis points. He says traders may remain cautious as more rate hike fears have resurfaced now. He expects the old 10-year benchmark bond yield to trade in a range of 7.37 to 7.43%, while the new one may trade in a narrow range of 7.36 to 7.41% for the day.
Well, it's the final day of earnings, so plenty of results to track, and we'll get to those stocks in just a bit in our special Top 10 segment. We're looking at Siemens, NMDC, Biocon, PI Industries, and Torrent Power. They are stocks on the back of positive news flow. On the flip side, we have Apollo Hospitals, ONGC, Bata, Radico Khaitan, as well as GMR Airports. They are stocks that could potentially react to negative news flow.
Okay, Matt Orton is now joining us. He's Chief Market Strategist at Raymond James Investment Management. Matt, good to have you with us here. Thanks very much. The inflation print overnight, it did not quite give it all clear, right, to markets, one way or the other. What is your own sense, Matt, in terms of how markets will continue to look at it? We've had one-day reaction to this print, but sometimes the real reaction comes on day 2, day 3. What's your sense?
Well, good morning, Prashant. Great to be back. And I think you're absolutely right. We need to wait a little bit longer to see what the actual reaction is going to be in the market. But from a first pass, I think what you were talking about earlier this morning, that it's positive that we continue to see inflation move lower. I think you can't deny that everything's moving in the right direction. But where I think the market continues to miss the mark is in expecting that the Fed isn't going to keep its foot on the brakes for a longer period of time. We've talked about this before, that higher for longer is going to remain the thesis. And bond markets have started to come around to that. Bond market pricing is much closer aligned to what Fed guidance has been. The issue is in the equity markets, and particularly in the lower quality, higher duration parts of the market. The Nasdaq, for example, was up almost 0.6% for the day. Part of that was due to a rally in Tesla, but at the end of the day, these higher duration companies need to properly value higher rates. I think until we can get to the point where you see the stocks that have led the rally so far this year have a little bit of wind come out of their sails, it's really hard to say that we're on sustainable footing for the market to move higher. So that's why when I've been speaking to our clients, I still advocate remaining more defensive in your core positioning, leaning into quality companies with higher free cash flow, earning stability. It hasn't been rewarded this year, but it's been rewarded for the past 9-10 months, and I think that's going to continue to play out as the equity markets start to move into agreement with the Federal Reserve as well.
So how are you feeling about the macro situation overall, not just in the US, but in a market like India as well? I mean, there is now a case being built for, this perhaps could be the final leg of the inflation battle in the US, and rates could move down from here. Is that your base case assumption as well? And what about a market like India?
I think rates are going to remain higher for longer, Sonia. And I think in the market right now, getting from 9 or 8% inflation down to 4%, that's the easy work. The much more difficult work is going to come from getting to 4% to 2%, which is where the Fed's target is. So we can't forget that even though inflation has come down nicely, there's still a lot of work that needs to be done, and the hardest work still needs to be done because services inflation is still sticky. We have a very, very tight labor market. There's 1.9 job openings per unemployed person in the US. That's an incredibly tight labor market, and there's going to continue to be upward pressure on wages as a result of that. So I think if you want to reach for more risk, I think you do it outside of the US or you do it in smaller cap US equities. And when I look outside of the US, the macro picture has improved markedly. So the picture in Europe has definitely improved. Winter has been warmer. I think the worst case recessionary scenarios are off the table. And in emerging markets, the dollar having moved lower has definitely benefited emerging markets. China reopening has provided more tailwinds for emerging markets. And what I like right now is that up until this point, the rally in EM has broadly been led by a narrow group of Chinese telecom and internet companies. We're seeing that start to broaden. We're seeing investors focus on more fundamentals, which is why I like India and Southeast Asia as well as Latin America.
Hi, Matt. Getting to the point on China, has China got overbought in the near term? I'm just looking at the steel inventory out there, and post the new year, in fact, it's up around 6 to around 7%. That gives me a sense that maybe, in fact, that demand or that reopen is not as was expected earlier. What's your sense? Is China overdone itself, at least in the near term?
I think so, Nigel. I think the Chinese trade, while I think it has legs, medium, longer term, I think the Chinese market is definitely overbought. And I think that's why you're seeing some investors start to rotate out of China, putting some more money to work in India. If you remember around the scandal and the news flow that came out around the Adani Group, I think China benefited from foreign money continuing to chase that reopening trade higher. You're starting to see a reversal of that, but the reopening theme still has legs to go. And that's why when I look at Asia more broadly, I think India is much more independent from the Chinese story, and it's a beneficiary of the rest of the global market doing well. But Southeast Asia is still tied to the macro impacts of China reopening, but you're not getting you're not taking on the direct risk of government regulation, geopolitical tensions that continue to be in the news, and you still have more room to have exposure to financials and commodities overseas rather than just in China. And they've lagged the broader emerging market complex as well. So I think that's where you want to focus your investments in emerging markets going forward.
Matt, just one last question. I'm starting to read even from mainstream commentators saying that maybe the Fed funds rate in the U.S. It's like a question now, but not a definitive statement. But could it get up to 6%? Any thoughts, Matt?
That's not my base case. I think the Fed is definitely data dependent. We're seeing good progress being made on the inflation front. I think you get to 5.25, and I still think that's where they're going to pause, but they're going to remain there for a longer period of time. So I expect that we're going to stay at 5.25 for the duration of 2023, and then hopefully the macro picture and inflation is improved enough they can start to take their foot off the brake.
All right, Matt, thanks very much. Great speaking with you. Appreciate you joining in. And it's a pleasure having you with us here. Thanks very much. Guys, I was saying this yesterday. The IIFL conference is going on, and yesterday there's a ex-CLSE economist who sort of addressed the audience and said that his view now is that Fed funds rate in the US will get up to 6%. We're at 4.75. Maximum markets are pricing another two hikes, right? So 50 basis points, but 6 and beyond will be completely uncharted kind of waters. And I'm starting to see people, mainstream economists, investment banks, etc., ask the question whether, we're going to be, when they keep saying this higher for longer, whether it's going to be higher at 5.5 for very long, or is it actually going to creep up all the way to 6% and beyond. We've not had rates this high, I think, since 2004. So no one remembers basically, right? Yeah. Everyone is used to 1%, 2%, right? Eventually it'll come down, but it's happened before. That's the only point that I'm making. So inflation is coming off, but no one really knows. People have their models, etc. But one needs to be cognizant. Okay, well, let's do one thing. Let's take a quick break. We have plenty of stocks to talk about on the other side of the break. Our research team will be joining in as well. So keep it with CNBC-TV18. All right.
right, welcome back to Bazaar Morning Call. We wake up this morning to negative cues from across the globe. The SGX Nifty is under pressure. The US markets were weak as well. But we have our entire research team to help us with how to approach trade. A lot of big numbers came through post-market hours, so let's get to that very quickly. Apollo Hospitals first on our radar. Ekta, how did it look?
Well, the margins were disappointing. Revenue was up 17%. Street was anticipating 15% growth. Margins came in at around 11.9%. Street was anticipating 12.5%. Profit of 162 crores. Over 200 crores was the estimate. Even Q on Q, there was a bit of a disappointment. Profit down 24%. Margins came off versus 13.3% in the previous quarter. Now, the key problem was the digital health and the pharmacy business, which is Apollo Health Co. It contains Apollo 24/7. The Q3 GMV was up 85% Q on Q. It's on track to deliver the GMV of around 1600 odd crores, but there was an EBIT loss of 74 crores, which widened versus 54 crores in the previous quarter. Diagnostics and the retail health segment also, there was an EBIT loss of 2.5 odd crores versus a profit of around 13 crores in the previous quarter. So that's where the problem lies. It's on the operating level where there has been a disappointment, and I suspect that the stock markets are not going to appreciate that. We do have a call at 2:30 p.m. this afternoon for more details.
Okay, well, you can catch the Apollo Hospitals management as well before the call. This happens at 9:40 a.m. on Bazaar today. So we'll perhaps try and get more details from Sunita Reddy on that. Thanks, Ekta, for joining in. Well, Sonal is with us. She'll tell us how ONGC's numbers were this time. Sonal, over to you.
Good morning, Sonia. Well, unlike Oil India, ONGC's numbers were lower than what the street was working with. The revenues came in flat on a quarter-on-quarter basis at 38,583 crore rupees, which is lower than the poll. EBITDA at 20,410 crore rupees, slightly lower than the poll, which was at 20,700 crore rupees. Margins absolutely in line, but profit was a miss of around 1,000 crore rupees, coming in at 11,044 crore rupees. On a quarter-on-quarter basis, revenues are flat. EBITDA is up 8.5%, but profit after tax is down 14%. In their segments, it was the onshore segment that did better than the offshore segment. So onshore segment saw EBIT of 12,619 crore rupees, while the offshore segment saw a decline of 800 crore rupees on a quarter-on-quarter basis. The positive is that the company has continued to announce dividend. This time around at 4 rupees per share. For 9 months, they have announced around 10.75 rupees per share. The estimation is that for the year, they'll be announcing around 16 rupees per share. The stock could see some red, but could recover because the triggers going forward for ONGC are quite strong.
All right, Sonal, thanks very much for that. Now, Siemens reported numbers right around market closing yesterday. Vivek is here with more details on this one. Vivek, hi, morning.
Well, good morning. It's been an extremely strong set of results from Siemens this time around. It's a clean beat across, when you're comparing it to the CNBC-TV18 poll. Revenues higher by 17%, closer to the 4,015 crore mark versus the poll of 3,960. Margins also the clean beat, 14.9% versus expectations of just around a little over 11%. And profitability at 463 crore versus the poll of 322 crore. No wonder then, most of the brokerage houses are very enthused by these set of results. In fact, Macquarie has retained its outperform rating on the stock, target price of 3,500. They're saying it's been a robust order inflow also that the company has witnessed, and they're saying that going forward, large locomotive order wins will be a key near-term catalyst as far as Siemens is concerned.
Okay, all right. Thanks a lot for that, Vivek. Well, I'm going with green for NMDC as well. The stock ended lower in yesterday's trading session. Maybe some part of the bad news, if any, was already in the price. The reported numbers are mostly in line with what we're working with, whether it's on the revenue, the EBITDA, the margins, as well as the profit number. The sales volumes number on expected lines was down by close to 3%. Remember, in the past quarter, you still had the impact of export duty that was, levied, which has now come off. So that will help volumes in the fourth quarter itself. And the average realizations as well, they were more or less flattish in the past quarter. The hope is that quarter 4 volumes will be much better. Prices as well, they have increased, so that will flow through. And the sweetener came in because they've declared dividend of around 3.75 rupees. And also you're expecting in the month of March or post March, you'll be getting another dividend out there. So going with green on the back of stable numbers, a better quarter 4 outlook as well as dividend play. But let's talk about Biocon. Ekta is back with us. Ekta, how is Biocon?
Well, it's difficult to compare this quarter because this quarter was aided by around 1 month of the Viatris biosimilar business being integrated into the business. But based on the estimates that we had and a couple of conversations that I've had, the numbers didn't look bad. Revenue was up 35%. We were anticipating over 20% growth. Margins of 21.9%. Estimates were 20.8%. Loss of 41.8 crores. This is versus estimates of a profit. But remember that the net loss was on account of an exceptional of over 270 odd crores pertaining to acquisition costs. Plus, they had a forex loss of around 44 crores this quarter. They also had a net R&D investment which was much higher year on year. Despite that, the margins have come in at around 21.9%. Now, biosimilars recorded the highest quarterly revenue by the company at around 1,507 crores, but this was also aided by Viatris. They are tracking to exit the FY23 with $1 billion in terms of sales for the biosimilar business. They are also in discussions with PE investors for an additional fundraise to pay down debt. So these are a couple of important points for Biocon. Overall, headline numbers look good. 9 a.m. is the call. We'll get more details then, so that will be important to track.
Okay, thanks a lot for that. Well, let's go back to Sonal now to talk about PI Industries and how the numbers look this time. Sonal, what's the lowdown?
Well, it's a stellar set, another quarter of operational beat, and that's why the stock could be in the green today. Revenues were slightly lower than what the street was working with at 1613 crore rupees, but EBITDA was higher at 416 crore rupees, margins at 26% versus a poll of 23.7%, and that's where the beat has really come in. Profits also higher at 352 crore rupees versus a poll of 307 crore rupees. On a YOY basis, now the company has seen a revenue growth of 19%, EBITDA is up 40%, margins are up 400 basis points in an environment where most of the companies have spoken about higher raw material prices. Profits are up 58% as well. Exports grew 23%. Domestic growth came in lower at 2%. That is because of adverse weather conditions and higher channel inventory. However, company says EBITDA margins improved because of favorable product mix and operating leverage as well. So green on PI Industries.
All right.
Okay.
Yeah.
All right. Thanks a lot for that, Sonal. Well, hopping across to Mangalam. Bata wasn't sprinting.
It was running, not sprinting. It has shown growth, but the street was anticipating a little more. So while the revenues of the company grew 7%, given the favorable base and unlock and a lot of demand for, school shoes, etc., people thought that the growth would be in double digit, but that wasn't the case to be. 900 crore in terms of revenue versus a poll of 961 crores, and that's flown down to the bottom line as well. The EBITDA was a mild miss, and the net profit as well at 83 crores was a 15% jump against a much higher jump that the street was anticipating. However, the trends are doing well for them. Men's dress category doing extremely well. School bounced back strongly is what the company says. And the overall sneaker sales for them, they've been adding sneaker stores, etc., have grown by around 142%. And women's category contributed about 1.3 times versus what they did the same time last year. So these are factors that bode well for the future. Let's see how it goes. They've crossed 2,000 overall stores. The stock has been an underperformer. See it being in mild red today, but we'll be interested to see whether some buy the dip or not on Bata.
All right, Mangalam, thanks very much for that. Surabhi has got Radico Khaitan and the lowdown there. Surabhi, hi, morning.
Radico Khaitan reported its third quarter numbers, and just like the other beverage companies, the numbers were not too impressive. The revenue growth was muted, up only 5% on a year-on-year basis, and that was also led by increase in realizations. The gross margin contracted close to 400 basis points due to input cost inflation. This has led to a 19% lower EBITDA on a year-on-year basis, and the EBITDA margins came in at 12% versus 16% same time last year. The PAT was down 20% and came in at 97 odd crores. The only silver lining in the results is that the premium segment seems to be working for them. The volumes in that segment were up 14% and the realizations were up 4% at 1,554 rupees per case. The regular segment that took a hit, the volumes were down 23% and the realizations were down 29% on a year-on-year basis.
All right, thanks a lot for that. Some more numbers coming through from the infrastructure space. You have Torrent Power, there's GMR Airports. Vivek is joining in to tell us more about that. Vivek.
Well, that's right. So Torrent Power, very strong revenue growth aided by, growth in all of the verticals. So revenues up almost 71% on a year-on-year basis. EBITDA also up almost 55%. But however, remember, EBITDA was created by growth across most of the verticals, including, the gas-based power trading business that the company has, the renewable, the distribution licensee, as well as the franchisee business. So, EBITDA going up quite strongly by 55%, margins at 22.5%, profitability up almost 86%, aided by a one-time gain of almost 400 crores due to the gas trading business. Now, coming to GMR Airports, although the company did report a significant return to profitability as far as the bottom line is concerned, aided by one-time. So while we're talking about revenues going higher by almost 30%, aided by strong passenger traffic growth, EBITDA was down almost 26%, marred by significantly higher expenses. Margins coming in at 30% versus 52.5% last time around. Profitability at 191 crore, aided by a one-time impact of 292 crore. This was on account of a reversal of lease receivables as well as gain on carrying value of investments. So expect some red as far as GMR Infra is concerned.
Okay, thanks a lot for that. That's a pretty long list. So here's a quick recap in case you missed out on any of these stocks. Stocks with positive news flow. There's Siemens, NMDC, Biocon, PI Industries and Torrent Power, while stocks with negative news flow, or weak numbers rather, Apollo Hospitals, ONGC, Bata, Radico Khaitan and GMR Airports Infra. Well, let's move on and get you a quick handle on what's happening in the world of commodities. Manisha Gupta is joining in. Manisha, good morning.
Morning, and thank you for that, Sonia. Well, I'm looking at the crude oil prices, which after hitting a 3-week highs of $87 a barrel, have continued to decline for the last couple of sessions. Overnight as well, crude prices fell by 2%. This is because the U.S. crude inventories have risen by 10.5 million barrels. The U.S. also is looking to release 26 million barrels from the SPR. And then EIA says that it's going to be a record March output from the U.S. shale basins going forward in the month of March. The only positive is coming in from the OPEC monthly report, which has put the demand estimate for 2023 up by 1 lakh barrels per day, and that would bring the overall 2023 demand estimate to 101.87 million barrels per day. OPEC also says that strong Chinese demand, lower output from OPEC and non-OPEC members will continue to make this market tighter, and they are expecting higher prices in the second half of this year. So still holding around that 84-85 mark, but definitely off the highs.
All right, Manisha, thank you very much for that, and one hopes it stays that way, well behaved and not too excited. That's oil prices. We'll take a break here. We are back with Nishchal Maheshwari for a quick chat on markets. We'll also have the management of Mahindra Holidays join us to talk about their third quarter numbers, which came some time back. Kavinder Singh is, of course, the managing director and CEO of the company, so we'll have a discussion there in a bit.
Welcome back. Hope you're having a good morning. Well, if you're just joining in, the SGX seems to be suggesting a bit of a downtick. That's because global Q is a little bit skittish on the back of the higher than expected inflation print that we got from the United States. But our markets did well yesterday, so let's see whether or not this dip gets bought into. Well, we have Nishchal Maheshwari of Centrum Broking who joins us on the show. Hi, Nishchal. Good morning. Well, irrespective of what the SGX Nifty is suggesting and what the Nifty opens up with, one stock that could be firmly in the green is PI Industries because those numbers look rock solid. What's your view on the stock?
Morning, Nigel. Yeah, I think once again a good set of numbers from PI Industries. And their CSM business also has done really well, basically. I think that was the worry basically the market had for the last many quarters, whether there's going to be sustainable this kind of growth or not. But the company has delivered, once again, very good set of numbers. So we continue to remain very positive on PI Industries.
Okay, positive on PI Industries. One set of numbers that came yesterday which looked quite cautious was Bharat Forge. Weak numbers on the back of both the slowdown in the domestic business as well as the overseas subsidiaries have been reporting losses. The debt optically has gone up, although the management is not too concerned. Brokerages are cautious post the earnings. Nomura, in fact, has downgraded the stock to a neutral. Their target price is still above the current market price, but they say that there is a cyclical slowdown in the traditional businesses, which is likely that could be offset through upsides from defense, from passenger vehicles and non-auto. Remember, there's a big order book in the defense space that Bharat Forge has bagged. Now, the overseas subsidiaries' EBITDA margins continue to remain weak, and Nomura believes that the stock is now trading at around 14 times FY25, which is fair value. Citi, in fact, has a sell with a target price of 690. So keep that on your radar as well. Overseas subsidiaries continue to disappoint. The losses in the overseas subsidiaries have expanded quarter on quarter. but the management says that there are multiple tailwinds for both revenue and profit growth. Nishchal, I wanted your thoughts on Bharat Forge. I do know you track that stock closely. Are you cautious here because of the losses that they are seeing in overseas subsidiaries, or do you believe that it can be offset by good growth in spaces like defense?
Morning, Sonia. For the moment, we do not cover it. But yes, I have tracked this stock for a long time. If I remember it right, basically, I think the big earnings driver has been the US truck sales. And I think that's where the caution is coming from most of the analysts, basically, because as you are going into a downturn in the growth as far as US is concerned, and also possibly a recession, I think that's where the caution is coming. But we do not cover it, so cannot tell you in more detail on this.
Nishchal, hi, morning. Do you have coverage in all cargo logistics? It sold off big time yesterday.
Yes, Prashant, we have coverage on all cargo.
Any thoughts? I mean, it recovered 10% from the lows, but still some 10-11 down. I mean, how do you rate it?
So we continue to have a positive stance there, basically. I think there has been some caution as far as exports and the cargo is concerned, especially the incoming cargo. So that's been the issue, basically, with all cargo for the moment. But we continue to believe that they have got a solid business, basically, and continue to hold a buy on there.
Okay, that's on all cargo logistics. Well, we'll just come back to you in a bit. In fact, I wanted your thoughts on Mahindra Holidays as well. We're going to get the management up in just a bit. The numbers were not too bad. It was a mixed quarter for them. The company reported a good performance in the domestic business, while losses continued for the European arm. Kavinder Singh, the MD and CEO at Mahindra Holidays and Resorts India, joins us now to discuss that. Mr. Singh, good morning and thanks for joining in. You don't really need to look at your numbers to know that the domestic business is doing well, right? Just one look outside and you'll tell hotels are full, flights are full. But I wanted to ask you about Europe first, because that's been the pain pocket for you. What's the turnaround plan for HCRO Europe? It's been dragging your performance for many quarters now.
Yeah, I think Q3 tends to be not a seasonal quarter for our European subsidiary. And you know that there have been high inflation in Europe and specifically even in Finland, and the geopolitical situation being what it is. Despite that, happy to report that at a consolidated level, if you exclude the one-offs, and these one-offs are in the nature of the forex mark-to-market movements, because we took overseas loan to finance and fund this acquisition. And as a result of which, even though the underlying assets are in euro, there is really no hit. But these one-off movements tend to not really show the picture. Even at a consolidated level, we were able to double our profit, PBT, even in this Q3, excluding the one-offs. Coming back to your question on turnaround, I think the company is already on its way to the turnaround. As you know, the last 2 years were related to the pandemic and now this geopolitical situation. But as we see Q4, because Q4 is a seasonal quarter, we are expecting superlative results from the subsidiary, and actually the turnaround process has already started. And you will see that in Q4. The occupancies are already looking up in January. And the best part is that this is a skiing season, holiday season. So we are expecting good results in Q4, and the trend will continue. But let's be very clear, Q1 and Q3 are not seasonal quarters in this subsidiary. And yet, despite that, we ended up doubling the profit before tax at a consolidated level.
Okay, all right. Good morning, sir. Thanks so much for joining in. You said occupancies are looking up, Mr. Singh. So could you quantify that number? What is the occupancy right now? For Q3, I think it was at around 85%. So give us a sense of that. And more importantly, the member addition target. That's very important. 9 months of this year, you've done what you did in the entire of last year. What is the quarterly run rate, or what is the number we should be looking at for FY24?
Right. So occupancies were very robust. Q3 is a seasonal quarter, so we ended up doing 85% occupancy on a higher room base, because we have added about 1,000 rooms in the last 2.5 years. And despite that, our occupancy went up to about 85%. By the way, January also closed at 86%. We are seeing a very good momentum continuing in this quarter. As far as member additions go, the good news on the member additions is that the member additions moved up by 13% on YOY basis, and a value sales basis, we were up by about 20%. And if you rightly said that in the 3 quarters, we have already completed what we did the whole year. So obviously, fourth quarter is anyway a good quarter for member additions. So let's see how it goes as far as the year end happens. But yes, talking about run rates, I think we are comfortably above the pre-pandemic levels in terms of run rate of member additions. The value sales are looking better. And that is helping us bolster our cash also, which is at 1089 crores, up 70 crores in this quarter.
Kavinder, just one point on this. So what should we work with? 4,000 plus every quarter in terms of member addition? Because it's just under 4,200 in Q3. And in Q2, that was about 4,400. Is there a bit of a, how should we read this number?
So the way to read these numbers is that, first of all, we have a multiple product portfolio. We are seeing huge momentum in upgrades, which means members are happy. And anyway, there is an upward trajectory. So we are comfortably above 4,000 level in every quarter. Our aim would be now to cross the 5,000 level, sooner than later. And that is how we are stepping up the gas in terms of ensuring that we are able to add members. One thing, the good news is that since we are adding inventory at a fairly brisk pace, and that is helping us to actually also boost our member additions.
So 5,000 levels, by when do you think you can add it? And your earlier target, I think, was 5,500 members by FY25. Do you hold on to that?
The 5,500 number is actually the rooms, cumulative rooms.
Sorry, the room event. Yes.
That we are well on track to achieve it, and that is happening without a doubt. So we are well on track to achieve the 5,500. We are well on track to move towards the 5,000 levels in terms of member additions. Of course, internally we make targets. Normally we don't provide guidance, but you can see the trajectory is positive.
Okay. But Mr. Singh, if you could leave us with a brief idea, this 5,000 per quarter, do you hit it sometime in FY24 itself?
Obviously, that's the aim, because in FY24, we would like to hit that kind of run rate. That's the aim, and that's what we are aiming to achieve. But remember one thing in our business, it's equally important to ensure that you are catching up on the inventory. And that's where we are seeing momentum. And when the inventory comes up, member additions go up. And as a result of which you are seeing now, we have improved the quality of member additions as well, as you can see. And that has also helped us in boosting our cash. And all metrics are positive, whether it is the profit growth, whether it is the margins. If you look at our margins, we did 300 bips higher than the pre-pandemic levels.
Yeah, no, absolutely. And I think that's an absolutely important point. You don't want members, you want happy customers, right? You want people to call up and get their rooms, right? And so inventory has to keep pace with, how many members you onboard. Because otherwise, I mean, the existing legacy customers are not very happy, even as shareholders are happy. Thank you very much, Kavinder. It's always pleasure. It's always a pleasure. Good speaking with you here on CNBC-TV18. So that's Mahindra Holidays with some perspective. Nichal is still with us. Nichal, just a bunch of names. So one is Reliance. I'm not sure. Yesterday went up about 2.5%. I was looking at charts. At least on charts, it looks like perhaps it's breaking out of a sort of downward trend, near-term downward trend. How is this looking? Any triggers you see for this one? Because this can do some heavy lifting if it catches some momentum. Your sense?
I agree with you, Prashant. Basically, though I do not follow charts, basically, but yes, it's at these prices, it is definitely a buy. Now, as far as triggers is concerned, I think market is waiting basically for a possible trigger of split in the company in separate listing. I think that is going to be the biggest trigger basically as far as Reliance is concerned. If you do a sum of part valuation, there is definitely value. Our target is also around 2,700 there. So there is definite value there, but I don't see any near-term triggers for Reliance at the moment.
Okay, no near-term triggers for Reliance. Let's do one thing. Let's take a break. Before we do that, let me tell you what's lined up in the next half hour of the show. Anuj will be joining in for a quick trade setup in a bit. Post that, we'll bring you the top stock picks for the day from our technical and F&O experts. And before the markets open in CNBC TV18 Stocks Board, we'll highlight the top stocks in the news to focus on for the day.
Okay, welcome back. We've got the market, which is racing to the pre-open 10 minutes or so. SGX is still indicating a 70-odd point lower start, 17,858 or so. Anuj is here in the studio to run us through what he's making of things. Anuj, hi, morning.
Morning, Prashant. You know, back to that trend line that the channel that we discussed, but highest close for Nifty since Jan 24. Now, what was significance of Jan 24? Because Nifty had fallen 514 points in 2 days after Jan 24, and we have now recovered 325 points, which is 63% retracement of the entire fall, which is very close to the top level sort of retracement. So in that case, there's a risk of a false breakout, but we'll watch out for how things turn out. I think one comforting factor that the bulls could take is the fact that the US market, while it rallied on inflation day, it was led by Nasdaq, though the more mature reaction normally comes next day. So today's reaction, I think, would be keenly watched out for. But Nasdaq closed up, defended 20-day exponential moving average and closed above 10-day exponential moving average. And Nifty IT already did that yesterday by defending the 20-day exponential moving average and closing above the 10-day exponential moving average. So the 20-day exponential moving average now becomes crucial for Nifty IT, which has been the leadership pocket for the market. The only worry is the US bond yield, which has moved up significantly over the last fortnight. And I think that could be a bit of a risk factor. I think on the Nifty, there's been no major call writing, while there's been so much put writing. So need to see if the put writers' conviction holds or not, especially if we start below 17,900 as suggested by the SGX Nifty. On the Bank Nifty, we close above one moving level, which is the 20-day exponential moving average, but slightly below the 50-day exponential moving average. So sort of no trade zone. And if you go by the options as well, 41,500 put and 42,000 call have the highest open interest. So that's sort of your range for the Bank Nifty today.
Okay, Anuj, thanks a lot for that. So we'll just wait by for the pre-opening rates to kick in. And in the meantime, we'll get Sudarshan Sukhani and Mitesh Thakkar to tell us how to approach the day. Gentlemen, morning to both of you. Sudarshan, are you getting a sense that perhaps the market is now finally ready to break above this range or not quite yet?
Good morning, Sonia. Not quite yet. Had it been ready to break, it would have opened with a gap up, not a gap down. So we had a breakout yesterday, and there is a very strong chance that this breakout could be a false breakout like so many earlier ones. Now, we let the market tell us, but my view is for today that if you have long positions, I suggest you close those long positions because we are going to go back into the trading range and let Wednesday spend itself. Let us see whether some new trend or some reliable indicators come by the end of trading today. But it's going to be a disappointing day and avoid it. It's another reason is that while the Nifty had a breakout yesterday, I think thanks to IT and Reliance, the Bank Nifty did not have that breakout. So the Bank Nifty did not support that up move, and that is also another reason why we should be avoiding both the indices today.
Okay, all right. Thanks for that, Sudarshan's not sounding very upbeat on the Nifty today, but let's get in Mitesh as well. Hi, Mitesh, morning. What's your trade on the index?
Morning, Ajit. The understanding is that the Nifty, managed to head towards the upper end of the range, which is about 17,950 to about 17,980. Now, today, if we would have got a gap up, I would have, possibly played for more upsides. But I think with the gap down, I think you are again, not sure whether we are going to see this level being crossed. So for the time being, I think still a choppy ring on kind of consolidation, broadly a 250 point kind of range, 17,950, 20, 30 points on the upside and 17,700 on the downside. So trading with more stock-specific biases, even the Bank Nifty, I think, is getting into contracting mode. So I think both the indices broadly consolidating. I think we might see another few days of sideways action.
All right. What about individual stocks then? What are we looking at? Mitesh, let me begin with you.
So I have a mix of buys and sells, 2 buys and 2 sells today. On the buying side is Reliance. If you get a 8-9 points kind of a lower opening, buy with a stop below 23.55 here. A target of 24.05 to begin with can be looked at, and once that is crossed, I'll look at even higher levels. ITC is a buy with a stop at 376 for targets of 400. And on the sell side is Apollo Hospitals. had some kind of a breakdown yesterday, big red candle. So that's a sell with a stop at 43.10 for targets of 41.80. And Honeywell Automation broke key support level, so could see more declines. That's a sell with a stop at 37.850 or just above it, and a target of around 36.400.
All right, Sudarshan, sorry, your trades, individual trades?
Well, the individual trades are also, not very good. They're just there because we need to have something on our minds. So Petronet is a buy. It's probably a better positional buy than intraday, but keep a stop under 215 and look to buy it. Godrej Properties is an intraday short. It's been in a steady bear market of its own. So short with a stop above 1184. Biocon is another stock that is in a bear market. You see, there are stocks that actually fall even when the Nifty is choppy. Biocon is an intraday short with a stop above 239. And TVS Motors is a positional buy. I think it's a very good, it's strong relative strength, good momentum, uptrend. You should consider, but not for today. Hold it for a few days. Stop under 1050.
Okay, thanks a lot for that, gentlemen. Let's take a quick break. On the other side, we will talk to the management of Landmark Cars. Sanjay Thakkar, the chairman and founder at Landmark Cars, will join in to discuss their Q3 numbers. Stay tuned.